UnitedHealth just posted a major revenue drop. Skyrocketing medical costs and Medicare spending are eating into profits. But is this just a short-term shock, or is it time to dump the stock for good? UnitedHealth, founded in 1974, is a leading healthcare and insurance company. The firm's UnitedHealthcare division provides health insurance plans for individuals, employers, and government programs, earning money primarily from premiums and government contracts for administering Medicare and Medicaid. Optum offers healthcare services through Optum Health, care delivery and virtual care, Optum Insight, healthcare analytics and consulting, and Optum Rx, pharmacy benefit management, making money from service fees, pharmacy revenues, and clinical care. The company is currently trading with a 3.3% starting dividend yield, compared to its 5-year average of just 1.42%. The price-to-earnings ratio stands at 12.7, well below its 5-year average of 20.1, and also lower than the current sector average of around 15.6. The stock is trading near the bottom of its 52-week price range, and based on analyst expectations, the fair value is estimated between $382 and $467. Yet, the stock is already available around $267. All of this strongly suggests the company is significantly undervalued. The company currently pays an annual dividend of $8.84, distributed quarterly. The next dividend payment is scheduled for September 24th, and shareholders who own the stock before September 16th will be eligible to receive it. The most recent dividend increase was 5.2%, while over the past 5 years, the company has raised its dividend by an average of 14.6% annually. Over the last 10 years, the average annual increase was even higher at 19.3%. Due to the sudden rise in expenses, this year's increase was smaller than what investors have come to expect from the company. Still, this marks the 15th consecutive year of dividend increases, and impressively, UnitedHealth has paid a dividend for 32 straight years without a single cut. The earnings payout ratio has consistently remained below 30% in recent years. While it's expected to rise to around 42% over the next 12 months, this is still well below any concerning threshold. The same holds true for the free cash flow payout ratio. Looking at the earnings per share chart, a significant drop is expected over the next 12 months. Free cash flow per share has historically been more volatile, which isn't surprising and has been the case in previous years as well. The EPS growth chart shows an anticipated 25% decline over the coming year. However, sales have continued to grow, up 8% over the last 12 months, and EPS also rose by the same amount during that time. The company is actively buying back its own shares, which is generally a positive signal for long-term investors. The total sales chart also shows steady year-over-year growth. Both return on equity and return on invested capital have consistently exceeded expectations over the past decade, which is reassuring. Unfortunately, the same can't be said about operating margin or free cash flow margin, where performance has been less stable. On the bright side, net debt to EBITDA has remained at healthy levels over the past 10 years, and net debt to capital is in a clear downward trend, now also at healthy levels for the past few years. The interest coverage chart has taken a bit of a hit recently, but even here, the company isn't showing any major red flags at this point. The company is currently offering a 3.30% starting dividend yield. The most recent dividend increase was 5.2%, and with a strong A+ credit rating, the company appears financially solid. The dividend also seems secure, making the stock look significantly undervalued at its current price level. Disclaimer: this video is for informational and educational purposes only. It does not constitute financial advice. Always do your own research before making any investment decisions, and never base a financial decision solely on the content of this video. UnitedHealth Group just released their second quarter 2025 results, and it's clear they're trying to stabilize after a turbulent first half of the year. So what do the numbers actually tell us? Total revenue for Q2 hit $111.6 billion, a solid $12.8 billion increase year over year. But profits, not so strong. Operating earnings dropped to $5.2 billion, and adjusted EPS came in at $4.08, down from $6.80 a year earlier. Margins are under serious pressure, with the medical care ratio rising to 89.4%, up 430 basis points year over year. That means healthcare costs are eating a much bigger slice of the pie than expected. For the full year, UnitedHealthcare expects revenues between $344 and $345.5 billion. That's over 15% growth from last year. But margins remain tight, with expected operating earnings between $9.0 and $9.3 billion, translating to an operating margin of just 2.6% to 2.7%. The pressure is coming largely from their Medicare Advantage segment. Medical cost trends are rising far beyond what they priced for, 7.5% actual versus just over 5% expected, and they now expect that to accelerate to nearly 10% in 2026. Meanwhile, Optum, UnitedHealth's services arm, is expected to bring in $266 to $267.5 billion in revenue, with operating earnings around $12.6 billion. But even here, growth is mixed. Optum Health revenue actually declined by 7% year over year, mainly due to changes in legacy contracts and underperforming risk-based health plans. Operating margin dropped to just 2.5% from 7.1%. On the bright side, Optum Insight saw a 6% revenue increase, and Optum Rx grew 19%, thanks to new clients and higher prescription volumes. Now looking ahead, the company reinstated its full-year guidance. Revenue between $445.5 and $448 billion, an adjusted EPS of at least $16. The message is clear. UnitedHealth sees 2025 as a rebuilding year, with real earnings growth expected to return in 2026. Adjusted EPS strips out one-time impacts like intangible amortization and the fallout from the Change Healthcare cyber attack. That's how they get to the $16 figure. So, is UnitedHealth a wounded giant with a comeback story? Or are these cost pressures here to stay? Drop your thoughts in the comments and don't forget to like and subscribe for more deep dives like this. Thanks for watching, and if you found value in today's video, give it a thumbs up and consider subscribing for more smart, long-term investing ideas. Stay patient, stay consistent, and keep building your path to financial freedom. Until next time, take care and happy investing.